That the market's getting more and more concerned about a potential Fed hike now, even though the conversation has been about cuts for a long time. The term hike is certainly working its way back into the conversation. Markets were closed on Monday, so we do have a bit of a shorter week in trading, but a lot to cover for sure. I'm Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal is to leave you feeling more empowered every week and bring to you some of the market data trends, the news that we're watching, hopefully weed out a bit of the noise along the way as well. And again, there is quite a bit to cover here today, even though markets were closed on Monday. So trading market hours were Tuesday to Friday here this week, but still a lot of data coming through. So just real quick, before we get into post-holiday weekend, on Friday before Memorial Weekend, we had consumer sentiment numbers come out. So consumer sentiment came out at 44.8. We also had U.S. leading economic indicators come out, which showed slightly positive at 0.1%. And then I wanted to touch on the consumer sentiment number because on Tuesday, we also had consumer confidence come out at 93.1. So kind of a similar lens to look through, I guess, in terms of what those two data points are measuring. And basically, this was the lowest that we've seen in a while. Now, that said, it did come in higher than expected, but nonetheless, this consumer confidence number was the lowest we've seen in quite some time. On top of that, we had a ton of data come out today on Thursday. So this morning we had the second GDP revision come out. This came out down a bit to, or I'm sorry, not down period, but down from the prior reading. So the revision came down a little bit from the prior reading. This was up 1.6%. Last reading, I believe it was 2% to give you some reference point. Second thing we had was income. So we had personal income come out. That number came out flat. We also had personal spending come out, which showed that we're up 0.5%, right in line with expectations. And then probably the bigger items that came out today were around inflation. So we had PCE data come out today, both the headline and the core number. Headline was up 0.4%, which was slightly below expectations, even with some of the challenges, in the Middle East. And then core PCE came out up 0.2%, also slightly below expectations. I believe this is why we're seeing markets react slightly positive in the morning anyways, was just a little bit lower than expected inflation reading. Not to say this means the Fed may not hike, but I think that the market's getting more and more concerned about a potential Fed hike now, even though the conversation has been about cuts for a long time. The term hike is certainly working its way back into the conversation. And so I think a lower inflation data point is maybe suggesting that the hike may not be as necessary. Obviously, neither of these data points were significantly below those expectations. So, it's not a whole lot of data to go off of, but I think that's why we're seeing the markets react slightly up today. Be sure to tune in next week. So next week we'll have a lot to cover as well. We have jobs week kicking off. So basically on the back of these inflation data points showing higher-ish inflation, let's say kind of similar to where we've been, but below expectations, the market's going to start looking towards jobs as well. And if we see any challenges in the labor market, that it could be almost a good news, bad news scenario at this point, because that could suggest the Fed may not be raising rates either. On the flip side, though, obviously, lower jobs growth can be a challenge longer term. So we'll continue to keep an eye on that as we roll out and get some data next week. Before we break this week, I did want to touch on a question of the week, which is a really good one, which is around fixed income markets or bond markets. And I'm going to touch on this on a very, very high level, but we've been talking a lot about the stock market this year, and rightfully so, because it's been one story after another and been a pretty strong year so far, even given all of that. But one thing that has maybe slipped under the radar a little bit has been the fixed income markets. And I mean that in a sense that, first off, there's not a lot to pay attention to there, but also because I think there's been so much focus on how all this translates to stocks that there hasn't been much attention on what's going on in bonds here this year. And it's important because there's been this conversation about interest rates decreasing for almost, yeah, 3 years now. So since 2022, where we saw a big change in rates, we've heard a lot of conversations about rates must come down and bonds are going to be a great place to be. Bonds are a necessary component of a portfolio, to be clear. But if you look this year, even when expectations were very high that interest rates were going to come down, on bonds specifically, we basically have a scenario where, general bond indexes, depending on which one you look at, are generally flat-ish for the year. We're also seeing the 10-year treasury yield is actually slightly up for the year, which means basically those bond prices are down. So just to keep in mind, there's an inverse relationship between interest rates and bond prices. So in other words, interest rates rise, bonds actually decrease, and vice versa. So higher yields, although you would get a better yield for your money, means that your prior bond at a lower yield is typically worth less. We can go into that another time. But anyways, where I'm going with all this is that the bond market has basically done almost nothing, if any, if anything. In fact, depending on where you look, could even be slightly down. And this is really important because we're seeing the continued expectations around inflation, which I think are driving that. And then obviously some of the geopolitical stuff going on this year is driving that to a degree as well. But it's important because the safe part of your portfolio needs to be safe. And we've been very cautious here in looking at this and kind of looking at shorter duration and alternatives to just your traditional fixed income, where it creates a little bit of cushion in these areas, especially like thinking back to 2022. So hopefully that helps. Again, we spent a lot of time on the stock market. I just wanted to switch gears a little bit and touch briefly anyways on where we're at with fixed income. But be sure to tune in next week. We got a ton to cover. We will basically just get right into jobs week. So we'll kick things off and then we'll have some to cover the following week, as well as we get some data next Friday. But be sure to tune in next Thursday. In the meantime, have a great upcoming weekend, and we'll see you next Thursday at 3.